Hi, it's Nash with AlphaFi. Today we are going to dive into MassMutual's 12-pay product. This product is not discussed so much, so I did want to cover it here. It is very, very similar to their Mass 10-pay, limited pay product, except you get essentially 2 more years to pay into the premiums. Limited pay products such as the 10-pay, 12-pay, etc., you can only pay for a limited time, so 10 years, 12 years, for example, you can pay premiums in, and then the policy is considered paid up, so that death benefit is all essentially paid for, and you don't have to and cannot contribute more premium into the policy. These products generally build cash value more quickly and also have a lower death benefit. So some good trade-offs to be aware of. Let's dive into the 12-pay product. Before we go, please hit that like, hit the subscribe. I would really appreciate it. Alright, the MassMutual 12-pay. Very high performing cash value product. Not as good as the MassMutual 10-pay, which we're going to look at in this video, side by side, but still pretty good. It's got a limited paying period, as we mentioned earlier, 12 years as indicated in the product name. It's got a lower death benefit as compared to longer premium paying period products. It's got a low guaranteed earnings rate of 3%, not as low as the 10-pay of 2%, but fairly low, and a high accumulation dividend, potentially a net IRR of 5% if it's a younger client. Today we're going to look at a 45-year-old male, and so we're not exactly going to hit that 5%. I think it's going to top out at 4.8 if I remember correctly, but definitely for younger clientele can definitely hit up to that 5%. We've set up a max cash value design for a 45-year-old male, select preferred. We've got $5,000 going to base premium, $45,000 going to PUA or their pure AILR PUA rider, additional life insurance rider. And it requires, in this instance, just as the 10-pay does, a renewable term rider. So we can't attach LISR here. It doesn't actually, the values don't look as favorable when we do that. But with these other, with these 10-pay and 12-pay designs, we mix in RTR. That is a cheap way to raise the death benefit, raising the MEC limit, allowing for us to fund in at a 1090 contribution of base premium to PUA dollars, allowing for a very high cash value designed product, not just a good product that we've selected. Okay, we talked about the whole life 12-pay guaranteed rate of 3%. Here's some of the other products just as comparison. And then quickly, we will have the loan option of going with adjustable loan policy loan interest rate or a fixed loan interest rate. Because we're not attaching LISR here, as we do on many MassMutual products, we will get the option. So it's important to note with the adjustable loan interest rate, it will be non-direct recognition, meaning they are not directly recognizing when you take a policy loan and adjusting any dividends. With the fixed loan interest rate option, they will directly recognize that we've taken a policy loan and adjust the dividend to match that fixed interest rate of 6%, which conveniently today is where the dividend is. So depending on where it sits in the future, whether the dividend goes up or goes down, it may benefit or hurt those values on the policy loan. Okay. All right, let's dive into the design here in a little bit of detail. So, just showing where the money is going into the policy. We've got $50,000 total for 12 years going into the policy, years 1 through 12 here. $50,000 total outlay. This is where it's going from year to year. So $5,000 going to base policy insurance or base premium, buying a whole life death benefit of just over $100,000. The rest is going to AILR as well as that renewable term rider here. And that renewable term rider is raising the death benefit, raising that MEC limit just to be a smidge over $50,000 so that we don't MEC out our policy. You can see it's listed on the MassMutual pages here at $50,000, $234.34. So right above that $50,000 limit. If we MEC our policy, it's going to trigger unfavorable tax consequences, which we want to avoid. we want to keep this tax-free, access tax-free, and enjoy the benefits of that. So that's why we do that, but it allows us to contribute this $45,000 total into the AILR and RTR here. So $50,000 total. This is the annual outlay. You can also see the semi-quarterly and monthly outlay if you want a different paying frequency. And then we're going to jump over to the net cash value at the end of the year here. A lot of companies will show end of year values because they'll pay that dividend at the end of the year. So it's assuming that is contributed already into your cash value. So $42,741 in cash value. We have a death benefit starting off of $894,000 on this 45-year-old male. We keep contributing here, $50,000 a year. Where do we break even? We break even in year 6. This is slightly worse than the 10 pay. So $50,000 for 6 years is $300,000 total out of pocket. We have $301,641 in cash value, just over that that $300,000, and then it begins to grow and compound from there. You can see we've got an $11,000 essentially gain the next year on top of our $50,000 contribution, and then it really starts taking off. And the death benefit does as well, because as we have guaranteed and dividend earnings on the policy, it is buying more AILR, which is essentially paid up additional whole life insurance, which comes with a death benefit and a corresponding cash value. And that's why when we stop contributing in years 13 and on, the values continue to grow and increase over time. So this was the 12 pay. Very, very similar to the 10 pay. You can see that there's $0 going into the policy after the 12th year, and so on. I do want to point out there is this this column here. We see a little bit of money still being, it says, annually surrendered. What's going on is we had to continue the RTR, the renewable term rider, for a few years to allow for this policy not to mech. So essentially it's keeping that death benefit high as the policy's PUAs or AILR contributions catch that death benefit up, and then we can drop it off. So you can see the death benefit actually drops a little bit here when we drop it from year 16 and 17. But we need that on there to balance it up a little bit until the policy could sustain its own growth and not mech out. So that's what that is, just in full transparency there. On the 10 pay, just as a comparison, we will notice it is very similar looking. $50,000 for 10 years. We also had to continue that RTR contribution, so we didn't mech out the policy. The mech limit is set at $50,402. So right there, that $50,000 is $5,000 going to base policy insurance, $43,933 going to AILR, so a little bit less going into RTR. The death benefit is a little bit lower, and the cash value is a little bit higher. Remember, we had $42,000, I believe, on the 12 pay. Yep, $42,741. So just slightly higher on the 10 pay. But we will notice here that the break even is actually much more cleanly in year 5. So instead of year 6 on the 12 pay, it's year 5 on the 10 pay. The reason this is because that guaranteed interest rate is lower and that death benefit requirement is a little bit lower on this product. More money, working capital, is going into less reserves for death benefit and more into investing into future potential returns for policyholders. So the IRR, the net IRR, is higher on this product, as well as the RTR charge being a little bit less. We don't have to buy as much death benefit to satisfy the mech testing. So the break even and the IRR is going to be much higher. This is going to be a better cash accumulation product, but we're limited to 10 years as opposed to those 2 more years for the 12 pay. But other than that, very similar products and very high cash accumulation. Let's look at them side by side. So I have those same products, 1090 splits on the Mass 10 pay and the 12 pay. Same 45-year-old male, select preferred NT, which stands for non-tobacco. The only difference here is the product type and the contributions in years 11 and 12. So as we take a look side by side here, what do we notice? Much higher cash value in year 1. So 89% coming back to cash value on the 10 pay, 85% on the 12 pay. As we come down here, we break even earlier on the 10 pay between years, almost year 4, 198, 177 with 200,000 total out of pocket. Just dollar for dollar, you can see we only have 190,000 in year 4 on the 12 pay. So breaks even earlier, and then you can see that the IRR pops out to be much higher on the 10 pay than it does on the 12 pay. Still very close, but definitely a higher performing product on a net IRR basis. But you're able to put in another $100,000 here. So, I mean, there is a lost opportunity cost with those additional couple of years. That's really the biggest difference in my mind. So you can see here the difference in cash value up until year 10, and then it's not that fair because the 12 pay you were putting in an additional $100,000. But you can see it's not, the 10 pay is not lagging behind by $100,000. It's actually quite a bit less because that accumulation is happening much faster. But the 12 pay, because we're compounding a bigger snowball, it does start catching back up. I hope this was helpful looking at the MassMutual 12 pay, comparing it to a very similar product, the MassMutual 10 pay. They're designed extremely similarly with those product differences there, and we can see the difference in accumulation, death benefit, guaranteed rates, and the similar loan options. All right, please hit that like, subscribe, and I'll talk to you soon. Thank you. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.